So thank you for attending Wake Up Clovis with the Clovis Chamber of Commerce. And our programs are Wake Up Clovis is sponsored by, we have some great sponsors. So we have Guardian Accounting, Clovis Community College, and the City of Clovis. So we thank them for helping us put together these informational Zoom meetings. Today, we're very happy to have Jessica Johnson here with us from Hick's Consulting Services. Did I get that right?
Hick's Pension Services.
Pension Service, thank you. So there's a new mandate, or not new, so it's been around for a couple of years, that the state of California wants all of us to save our money. And so we have some money in retirement, so the state doesn't have to take care of us apparently when we're old. So they're kind of forcing employers to have a retirement plan for their employees, which I don't think is overly a bad thing. The forcing part might be the bad part. But with it's called CalSavers, which is the state-run plan, and we brought Jessica from Hick's on today. She is an expert on the CalSavers, on the California employee and employer relationship and the plans. So I'm going to turn the microphone and the screen over to Jessica. She's going to tell us about what CalSavers is, what our requirements are as employers in California, and how we can become compliant so we don't get fined. So Jessica, take it away.
Thank you, I appreciate it. I'm going to screen share real quick, so just give me a second. I see you, Jennifer. Good to see you via Zoom. Okay, so let me just make this bigger real quick. Yes, so I'm Jessica Johnson. I'm with Hick's Pension Services. We're a third-party administrator. So all we do is retirement plans for employers. So essentially this law is really impacting our business with helping employers in California specifically that are being impacted by this mandate. We've been in business since 1968, family owned and operated. We have 4 locations, over 6,000 plans. I'm a one-trick pony. It's all I do is retirement plans for employers. My role as a consultant is to work with business owners, your financial advisor, your CPA, to help you establish a retirement plan that's going to meet your objectives, but also play within all the fun rules that we have to follow, which there are a lot of them. And I'm going to keep that real short, but I've been in my company 13 years. I'm not going anywhere, right here in Fresno, California, so sister city to Clovis. So I'm going to get into this. This is really timely. There's a big deadline coming up that's going to impact the majority of the employers in California that currently do not have a retirement plan in place. So quick agenda. We're going to go like high level. What is CalSavers? Employer responsibilities and involvement if you choose to go with the state alternative, which is called CalSavers, versus coming out in the private market with a financial advisor, us as a third-party administrator to set up like a 401k as an example. And then fees and penalties for non-compliance, which by the way, the state is actually already starting to send out penalties. So they are enforcing this mandate. They're not taking this lightly. And then how to become what they're calling an exempt employer based on this mandate, requiring you to establish a retirement plan. So this law was actually passed back in September of 2016. It was signed by Jerry Brown, and it was Senate Bill 1234. I like to say 1, 2, 3, 4. It's a little cuter, but essentially what that was a law requiring all employers in California with 5 employees or more to establish a retirement plan. And basically it took the state about 3 years to get their alternative, which is called CalSavers, established and available for employers to go to. And then the mandate actually rolled out starting, it was September 30 of 2020. If you had 100 employees or more, you could set up a 401k plan or go with the state alternative. June 30 of 2021, if you had 50 employees or more, so that deadline is already passed. This year is 5 employees or more by June 30 of 2022. You either have to set up one of the qualifying retirement plans, which we'll go to. I'll go through the list and then also, or go into the state option. You have to do one or the other. This is the actual mandate. And like I said earlier, we're going to go through the penalties for non-compliance, but I already have some real life examples of employers that have been hit with the penalty just recently. So the state's estimating there's anywhere between 200,000 and 250,000 employers in California that are going to be impacted by this mandate. And so, I mean, there's a really big number. The majority of those employers are falling, as you can imagine, into this June, the 2022 deadline with 5 employees or more, because the majority of businesses have less than 50 employees, just by the nature of small businesses. What's really important to understand is the definition that the state is using for an employee for the 100, the 50, and the 5 is age 18, paid by W-2, and you work 30 days. So no hour requirement, nothing. So to be dramatic, you've been on payroll, you have an employee on payroll over the age of 18, they could work 1 hour a week and they're going to count towards that 100, the 50, and the 5. So if you think about like the, at this point, the other 2 deadlines have passed, which a lot of employers have missed that deadline. They're not aware of the law. They think the state's not going to enforce it. There's a lot of kind of variables on why an employer that has missed a deadline hasn't done anything. But essentially by June of this year, pretty much every employer in California is going to have to do something, whether it's going in the state option or coming out into the private market. And we're going to talk at the end of the member benefit that Clovis has stepped up to help all of their members with, to basically meet this requirement for the mandate. But also equally, they're not only using that definition, which is almost nothing for an employee, is they're using the EDD following 3/4 average of that definition of the employee when the mandate applies to your business accordingly. So the easiest way to explain that is we're in 2022. How many W-2s did you issue in 2021? If it was more than 5 and they were on payroll for 30 days or more, then you have to do something this year. So it doesn't necessarily mean if you have 3 people on staff right now, it's how many did you issue basically the following 3/4 to the California EDD, which by the way, the EDD is in charge of enforcement of this mandate. The state treasury, California Treasury, they're the ones that design the plan. They have a board. They're kind of in charge of CalSavers, but the EDD is in charge of enforcement.
Hey, Jessica, can I just interrupt you real quick and ask just a basic question?
Of course.
If I had a special event and I hired, it was for 1 month, I hired 10 employees, okay? The event happened and then I let go of 10 employees. So now I was down to 3 again. Would I still have to have a retirement plan if I only have 3 employees? If I hired and let go of 10 people within a month, let's say.
If they were on for 30 days, then yes, you would have to do something.
Even if that it was just a temporary deal and my normal crew was 3 people.
Correct.
Wow.
Yeah.
Okay.
And I know I'm going through this quick. It's just a lot of information. So feel free to interrupt me and ask questions. I think that's great, because it's kind of a lot of this is mind boggling, especially when they get into the employer responsibilities on a day-to-day if they go with the state option. So one thing I like to note is nonprofits are not exempt from this law. So they have to do something equally just like a for-profit company. And then out-of-state corporations. So let's say you have a business, you're headquartered in Nevada, and you have California employees that you're reporting to the California EDD who reside here. If those California employees are not covered under a retirement plan, that basically that out-of-state corporation has to cover, it applies to their business as well. So it's even going over state lines. And so, the state is really wanting all employees in California to save for retirement, and they're doing it through the employer, essentially. Not essentially, they are. So high level, just kind of what is the state option that they created for employers to go to. So it's essentially Roth IRAs only. And they're saying they're going to add the option to have a pre-tax IRA at some point in the future. But even in the final regulations, and I could be wrong, I poked around on the website not too long ago, and the pre-tax option is not available yet. It could be now, it could be wrong, but I haven't seen it. And I think that honestly, the reason for that is the state doesn't know basically the tax implications for revenue, because Roth IRA, you pay the taxes now, pre-tax, you save in taxes and you pay at retirement. And the state is saying that they're estimating there's 7.5 million employees in California that when they retire, they, or could no longer work, they have less than $3,000 in their savings account and 0 retirement, and they're not covered under a retirement plan with their employer. So that's really what they're saying the intent is of this law. Like I mentioned earlier, of just, getting employees to start saving for retirement. That's a really big number of employees in California. And so there's an auto enroll in the CalSavers option. None of these features, by the way, you can turn on or off. This is what the state created. You either go into their option or you come out and you have more control and come out into the private market with one of the qualifying plans that they're making available to basically be an exempt employer. There's an auto escalate of 1% each year up to 8%. The employee can opt out. So as an employer, you choose to go in the state option. The employee has to get auto enrolled, but if they make an election, they say, I don't want to participate, they fill out a form, or they say, I can't afford 5%, but I can do, $15 a paycheck or whatever the case may be. They can make a different election, but they have to take action to do that. What I foresee being challenging is the household income limitations apply to the Roth IRAs, just like if you were to go out to, to your bank or a financial advisor and set up an IRA. And so the employee is required to know if their household income is in line. And I don't know that I'm not an advisor to the limits, but there's, depending on if you're married or single, there's basically your household income limits you if you even qualify to participate in a Roth IRA. And the employee is responsible for opting out of the auto enroll if they don't qualify, which makes sense because as an employer, how would you know if your employee's household income, is in line with the limits for that year, which changes every year. And so what I foresee being challenging, which I'm already actually hearing from some employers, is if the employee is participating and they don't opt out, there's no correction to back out those contributions. And so you're doing this deduction in payroll for your employee. And so they're going to still, even though how would you know what their income is? They're going to be frustrated because what happens is there's no correction. They have to pay all the penalties when they find out when they go to their taxes that they actually qualify for the Roth IRA. So there's going to probably be some frustration there, I would imagine, from an employee-employer kind of dynamic. And then the other thing is, so there's no employer contributions. There's no match coming from the company to your employee. There's no profit sharing. It's only employee dollars going into an IRA in the state plan on their behalf through payroll. And we'll get into more detail about that. So there's a record keeper. So these are not actually, the IRAs under the CalSavers umbrella is not actually being held by the Treasury. So there is a record keeper that's housing all of them. Like you might hear like Voya, John Hancock, American Funds, Principal, Transamerica. So it's a census is a record keeper that's actually housing all these IRAs. So it's not really being housed by the state. They selected a company to house all the IRAs. And then the fees are all being paid out of the IRAs from the employee's IRA account. And it's anywhere between 0.82 to 0.95% based on what investment the employee selects. What's interesting is the state is receiving 5 basis points, which is gonna like a fraction of a percent. Not gonna get in the weeds on that, but they're receiving 5 basis points out of the whole entire CalSavers, all the IRAs. And what the state is saying is that's to pay for, basically that there was, at the time, I don't know how many employees there are now, there were 6 employees with the Treasury. This was back in the summer of 2019. We had a call with the outreach director, who was kind of the top employee for CalSavers Treasury. And he was just saying it's to pay for their salaries, their benefits, the taxpayer dollars that have been spent. A lot of you have seen all the marketing material, I would imagine, the website, all of that to pay back taxpayer dollars. And so, the state is saying basically the board has complete control over this 5 basis points. So they can either increase it, decrease it, kind of as they see fit. The fund family that won the business, this is the investment options for the employees, it's called State Street. And there's a target date suite, which is basically, the employee based on their age, they get put into whatever target date based on when they're going to retire, how old they are. We call it in the 401k world, like the do it for me option, lifestyle fund. So that's good. So there's an option there. There's a couple of global equity funds, there's a bond fund, and there's a money market fund. And so what's interesting about the money market fund is the first $1,000, if an employee gets auto enrolled, goes into the money market fund, and they're going to be paying basically 1%. So the employee is essentially going to be losing money, frankly, and when that first $1,000 in the money market fund. And so I don't really understand why they're doing that. In the 401k world, you automatically get defaulted in auto enroll if you don't make an investment election in your target date fund, because that's in the best interest of the employee, And so I'm not sure why they're doing that. I would imagine it's for revenue, just to keep the plan going, because there's a cost to this. The Roth IRAs are portable, which is good for the employee. So if they were to leave, come out to an employer, let's say one of my clients has a 401k plan, they can roll that Roth IRA into the 401k. They can move it out to their bank, wherever they see fit. So that's a benefit for the employee, that it's not stuck with the state, plan indefinitely. Okay, so this is on a day-to-day basis from an employer perspective. If you choose to go with the state option of what you're required to do. So basically you have to submit a full census to the state and you have to keep them updated. So this is going to be something that happens all throughout the year because you have a 30-day eligibility period, for all of your employees. So as, your employees, you have turnover, you have to basically give all of their census data to the state for the CalSavers plan. You have to also track all throughout the year who's eligible, which again, it's a very short period. So at 30 days from data hire, you are required to basically provide an enrollment packet or notify the employee that they're eligible for this plan. Now at 60 days from data hire, if they do not respond, then you have to auto enroll them in payroll at that 5% Roth contribution out of their paycheck, which by the way, Roth, like I said earlier, you pay the taxes now. So it's literally going to be a 5% deduction right off the top of that employee's check. You also have to track the auto escalate. So auto escalate is basically like a way to kind of nudge an employee a little bit at a time to start, contributing more for retirement. So the auto escalate, is 1% each year up to 8% on top of that 5. So it's okay, Jessica, she needs to go to 6% this year because everyone is going to be on a different level depending on when they were hired. And then Greg, okay, he's capped at 8. And so each employee, the employer has to track where they're at and how much they need to increase each year. What's interesting is there's the auto enroll, the employee, let's say you have an employee as an example that says, okay, I actually want to participate, but I can't afford the 5%, or maybe I want to do a little bit more. But they say they have to make a separate election for the auto escalate. So I have to say, I do not want you to increase me. And this happens in January, by the way. So they say, I want to participate, but do not increase me because for whatever the reason is, it doesn't matter. They can't afford it or they're comfortable with whatever they elected to do on their own. And so what happens is the employer, I created, this is my highly technical term, when I was reading through the regulations, trying to figure out what the state was requiring an employer to do on a day-to-day. I call it like a 6-month look back for auto escalate. So as an employer, you have to track your employees that have been participating each year, by the way, for 6 months or longer, but they said, do not increase me in January. I don't want the auto escalate to happen. Each year as an employer, you have to go back to those employees in November and say, if you do not re-opt out of auto escalate, I have to increase you again. This happens every single year. I call this like auto enroll on steroids. And frankly, if I was to design this plan for an employer as a consultant, because there's definitely an administrative aspect to a 401k, you'd probably fire me immediately and go to one of my friendly competitors down the street. Like, Jessica, what did you sign me up for? Because it's just this kind of never ending auto enroll that just continues. And so the employer, you're also required to hold an open enrollment. They say every 2 years, and this is in November. So in that period, anyone that hasn't been participating, they said, I don't want to participate at all. You have to go back to them if they haven't been participating for a year or longer, assuming that they're still on, still working for you, and re-auto enroll them. And so it's just this kind of whirlwind that doesn't ever stop of auto enroll, and it all falls on the employer's plate to handle it. And so keep in mind, there's no financial advisor, there's no one to support you as an employer to help come implement this. So it all is falling on your plate. And the employees with no advisor, there's going to be like an 800 number they call if they decide to call to get, I guess, advice. I would imagine they have someone they can talk to about how to invest their money. And keep in mind too, they get their first paycheck, which I hear a lot of, especially in the Central Valley. They're going to get their first paycheck and be like, what is this deduction out of my paycheck? And they're going to be like, stop that. So you're going to stop it in payroll. Then the employee is going to have to go to the state, the record keeper, and try to get that contribution back. And a lot of these employees in that 7.5 million number, maybe not, I don't know, I don't have a number of that, but they need every dollar to feed their families, pay for their rent, pay for their mortgage, pay for gas, which gas we all know is insane right now, and pay for groceries. So it's like, they're trying to like capture all these employees to save for retirement. The problem is they can't afford it, especially here in California, just with like living expenses. We all know that. So it's just this kind of quandary that the state has created, and they're saying it's to try to help. But I have I've had a lot of conversations, and there's a lot of employees and employers are like, my employees will not be okay with this deduction out of their paycheck. So the state's saying there's no cost for CalSavers, but we all know going through the administrative tasks you have to do on a day-to-day, there's obviously a time cost for whoever's managing that for it. Like, whether it's you as the employer, do your own payroll, you have to hire somebody. Typically I get through a quarter of those employer responsibilities and I have employers say, Jessica, stop. Like, I want nothing to do with that. There's no way your 401k is going to cost me what it's going to take for hiring a team of people, depending on how big the company is, $50,000 a year employee, just to manage that on a day-to-day basis. So the state did a news release. It was January 12th of 2022. And basically it said, California will be enforcing these penalties effective now. And so I had an advisor down in Tulare County area that emailed me a few weeks ago. And it's a grocery store chain that had right now on payroll, they've got about 100 employees. They just got a penalty for $35,000. It was not a warning because they were supposed to do something in 2020 and they did not. So the state is not taking this lightly. The only grace they gave for COVID was moving that 100+ deadline from June 30 of 2020 to September 30 of 2020. That's it. And now they're starting to enforce the penalties on the larger employers that didn't do something. So at 90 days of notice of violation, it's $250 per eligible employee, which we know the definition for an employee is basically nothing. It's age 18, 30 days. Then at 180 days of notice of violation, it goes up to an additional $500. So now we're talking $750 per employee. And what I find frightening is when I had the call with the outreach director, who, by the way, was super helpful. He answered a lot of my questions that I had that were coming up as I was talking about this law more back in 2019 specifically. I was like, okay, so I see the penalties for noncompliance, and I get this question a lot. How often and when are you going to assess this? And he was like, well, this is what's in the law that was passed. He was like, basically, we're figuring it out as we go. We don't know. And so I was just like, that's a little frightening to me because that means they're giving themselves a lot of leeway on how they're going to enforce this penalty. And when it's like when they catch you 2-3 years down the road, we didn't do anything, it's going to be ×3. We don't know. And so the state is obviously going to be adapting as they start enforcing these penalties. And it frankly feels like an income generator for them. So the whole point of coming out, if you don't want to go with the state option, you don't want the EDD snooping around, because at some point they will come in and audit your CalSavers plan, make sure you're operating it properly. Because if you think about it, you have, let's say, an ad company that brings on an additional 400 seasonal employees that work 4 to 6 months out of the year. Technically, all those employees should be uploaded to the state, auto-enrolled if they don't respond. But an employer with the interest of their employees in mind, knowing that they don't want to participate, they might forget to upload all of those employees to the state plan. There's going to have to be some sort of consequences to that. I even asked the question when I figured out all this auto enroll that the employer was going to have to do, because we do auto enroll in the 401k space, but a lot of times we talk about it. And again, there's an administrative aspect even to a 401k. And a lot of times employers are like, I love the idea of that, but I really don't want to deal with that on a day-to-day basis. And we're talking a much simpler auto enroll. And so I asked, so what happens if an employer, frankly, messes up the auto enroll in any sort of way in the state plan? And he was like, well, we're going to try to, make sure employers understand what they're responsible for in our plan. So, but ultimately, this is our plan. If you come into CalSavers, you have to operate it properly. So, there's going to have to be at a certain point, which probably is a ways down the way, because right now they're starting with penalties for like the 100+ that didn't do anything. They're going to have to come in and audit to make sure employers are operating the CalSavers plan properly. So the whole point is, if you come out into the private market and you want to be an exempt employer from the mandate, is we help you establish, as an example, a 401k plan. There are other qualifying plans. You can do a simple, a SEP. You can do just profit sharing only. You can do a 403b plan, which is for nonprofits. I'm, in the qualified plan space, so I don't help with simples and all that. So we're going to talk about a 401k just to kind of give you an idea of what we can do. And essentially in a 401k plan, which kind of flips the CalSavers plan completely on its head immediately, is we can do eligibility of age 21, 1 year of service, and you work 1,000 hours in the year before you're even eligible for the plan. So that completely eliminates that age 18, 30-day, no hour requirement of who you have to offer the plan to. On top of that, versus the whirlwind all throughout the year of having to offer the CalSavers plan to your employees is we can do twice a year entry. So you only have to think about twice a year of who's eligible for your plan. So just those two factors are a really big reason why a lot of my new clients, because of this mandate, are going with the 401k plan versus the CalSavers alternative. And by the way, you have a financial advisor, which I'm not an advisor. We're the fund compliance police for 401k plans, but you have a financial advisor that twice a year entry, if that's what you choose to do, to help you educate your employees, give them investment advice, help them make sure they're saving for retirement, debt planning, all of that. So, you know, you're getting that support from not only my team to keep you compliant in the 401k space, but also financial advisor to help you. And I get this question a lot, so I'm just going to mention this. The CalSavers option, you can do a 401k with these rules and you're still exempt. So you do not have to basically, you know, mimic the CalSavers definition of an employee and when you offer it to them to be exempt. So all of my Hicks clients, my 6,000 plus, you know, clients that we have, they're all of their plans are designed very differently depending on their objective. They're all exempt. So it's basically because federal under ERISA is what manages, you know, our 401k world. And this is a state law that the state created. So if you have a plan in place, it doesn't mimic your, you know, the CalSavers options, you're exempt and you're good to go. And there is no like kind of plug and play cookie cutter alternative for CalSavers that I have for an employer. We're sitting down with each individual employer, just like I would all these years that I've been working for my company, and help you design a plan that's going to meet your objective, whether it's checking the box because you're getting forced to do something, or maybe you actually feel like you need to set up a retirement plan because your employees are asking for it, which I'm hearing all across the country because I do business nationally. And so, you know, I don't lose that individual consulting with each employer to help you establish a plan. It's just, sometimes I'm meeting the table because you're getting forced to do something by the state. The limits are a lot higher in a 401k. I'm not really going to go in the weeds on this. So it's a really good benefit for an employee, for an employer, even personally, because all of my employers that I've talked to, they wouldn't even qualify to even participate in the state option because of those household income limitations. All employer contributions are tax deductible. So if you choose to do a match or an additional employer contribution, it's all tax deductible to your business. There's a lot of benefits in the qualified space that you wouldn't be getting if you go in the state option. And, you know, it's a great attraction retention tool. So imagine you have a higher paid employee that you're trying to attract to come over. And it's like, okay, I have this CalSavers plan. You can put away $6,500 of your own money. I'm not going to give you an employer contribution. Oh yeah. And if you qualify, if you don't, I'm going to have to come to you every year and make you opt out. As an employee, I think that would be incredibly frustrating. Like, I told you I don't want to participate. I don't qualify, but it has to happen each year. If you don't prove that to the state, they come in and audit you, the EDD, then we don't even know what the consequences of that are, which is a little bit scary to me. So the stars aligned for California employers, where a law was passed in December of 2019, and it was a federal law. And the feds, it's like substantially, it's called the Secure Act, but they substantially increased the tax credit for an employer to establish a retirement plan years going 2020 going forward, which is when the mandate rolled out. It has nothing to do with California, but it's a federal tax credit. So it went from $500 for 3 years for an employer. Essentially, it's to incentivize an employer to establish a retirement plan for their employees. But it went from $500 for 3 years up to potentially $5,000 for 3 years. So there's a weird formula. You can talk to your CPA about it, but you can almost get 15 grand to establish a retirement plan. So that's great. It's helping us offset a lot of costs, my fees, if you want to do an employer contribution. So we can have a lot of creative ways to try to use basically as much of that credit as possible. Where I already talked about tax deductibility for an employer contribution. You can have your participants pay some or all the fees. If you have a bigger company and you haven't done anything yet, you definitely want to do something like yesterday, basically 2020. We have creative ways to, basically there's a large plan audit, which I'm not going to really get into the weeds about, but we have creative ways to try to avoid that. Because a lot of my bigger clients that got forced into doing something had never established a plan before because it just felt like it was too expensive, but then they had to. So I have a lot of options for that as well. And essentially, so you are not required to self-report that you're exempt. So let's say you have a 401k in place, you have a simple, and you're already exempt. But if you go to CalSavers.com, there's on the landing page, you can self-report. It's one of those things where I actually recommend it, where you're not getting yourself on the state's radar, you're actually getting yourself off their radar. We have a lot of clients that send us notices like, what is this? They're like, it's because some of it, I call them like nasty grams. Some of them are fairly aggressive that are coming from all different parties about this law. And as soon as they self-report they're exempt, then they get left alone immediately. If you have multiple businesses with separate EIN numbers and you're all covered under one plan, you want to make sure and self-report each EIN, because the state's applying this mandate by an individual EIN number. So as an example, we have a big auto dealer that has, I think, like 5 or 6 locations. All of those locations, separate entities, but they're all covered under one 401k plan that we administer for them. And so our client went in and basically self-reported the top EIN that's reported on the public form that we file for our clients, tax form that's required. And so she was still getting hounded, even though she self-reported. So we had her go on and do every single EIN because they are exempt. And then she got left alone. So it's definitely something I recommend to do. You need an access code. You'll see it. It's pretty clear. It takes like 2 minutes, but it's definitely something I would recommend doing, especially if you're getting a bunch of notices and you have a plan in place or you're going to put a plan in place. So that's normally I'd ask questions or have questions. But Greg, so the Clovis Chamber, and I'm going to let him chat about this a little bit too. We're working with the Clovis Chamber. They've really stepped up for all of their members, and they're offering a benefit that's going to be a solution in the 401k space to help their members become exempt. And that's where we're their team to work with members, but again, on an individual basis. We're not losing that consulting aspect. Very, very cost effective. It's a great solution. It's not a new in the marketplace, and I don't want to start throwing out a bunch of terms, but it's definitely something that if you want to learn more about what they're offering for their members, we're more than happy to sit down with you on an individual basis and explain it and make sure you understand. It's basically a plug and play retirement plan that as an employer, you really almost have zero responsibility. I'm not going to say you have absolutely zero, but it's pretty much plug and play. And I'm really excited the Chamber stepped up to offer that for their members because it's really, really timely. Whether you need a new plan, no plan is too small, by the way. Doesn't matter how big your company is. If you have a handful of employees or you have 200 employees, it's a great solution. And it's going to take almost all administrative burden off your plate as an employer.
Well, thank you, Jessica, and thank you for helping us with understanding the CalSavers and then the requirement for the employers. And yes, so for our viewers today, as a Clovis Chamber, we're here to help our businesses succeed. And when we see a potential, we'll call it problem, or a mandate that our businesses are going to be required to pay attention to, we jumped right in to figure out, okay, how can we as a Clovis Chamber help solve some of these problems for our employees? So there was a new law passed a couple years ago that allowed associations to put together a multi-employer plan, or an MEP, I guess it's called. And what that does is it's a pooled resource plan that will allow, going under the Clovis Chamber heading, that will allow our members to have reduced fees because all of the assets are pooled. So the more assets in the plan, the less the fees. It lowers the administrative cost. It eliminates some of the fiduciary responsibility from the employer. It does all these great things. So we did work with Hicks. We worked with the principal, and we're working with Transamerica to have which is a Clovis Chamber MEP plan. It's an open plan that Hicks is going to be the administrator for, and Jessica will be our point person. But it's an alternative to CalSavers. It's an alternative to a employer going out on their own and putting together a plan on their own, because it does save a lot in fees. It saves a lot in time. It saves the audit costs if you have 100 more employees. And so it just made sense for us to put our name behind it, the Clovis Chamber's name. So Jessica, do you want to just briefly tell us what the difference is or what the benefit is of the Clovis Chamber's MEP program versus if somebody was to go out on their own, or we already talked about the CalSavers. So we already understand the benefits of compared to that, but what's the benefit of the Clovis program, Clovis Chamber versus just going out on their own?
So really the biggest benefit, the idea of a MEP, a multiple employer plan that Clovis is sponsoring for all of its members, is you're essentially taking all of your members and you're pooling all together your assets, basically. Not basically, you are. And so the cost for it is substantially less versus coming out on your own, which we can do, which most of our clients that way, but really the market is moving this way, because why not pool together, especially under an association when you already have commonality. And basically, you know, it's way more cost effective than going out on your own and setting up your own individual plan where it's just your employees and, you know, all of their retirement accounts. So the cost is substantially less. But on top of that, we've layered on a bunch of different protections, as in there's something called, and I know it's called 316 services. And this is where we can individually talk to you and explain what this means. But Hick's, my company, we're signing on as a co-fiduciary with the chamber, with you, but our firm, and we're doing all the administrative day-to-day aspect of a 401k for you under the chamber plan. So we're distributing notices, we're preparing, signing a 5500, we're preparing, signing all of your distributions for your participants. So we're doing all of the administration, which we normally do outside of an MEP, but we're also signing as a co-fiduciary with you and taking on all the day-to-day aspect of a 401k. Essentially, which we could also potentially help with this as well, is you're pushing payroll. And so it's a plug and play, really cost-effective option. The marketplace is really moving that way. So I'm really excited. There's a lot, we're working with some other chambers that are sponsoring these as well, which, you know, Greg and their team knows about this, down in Bakersfield, San Jose. And so it's a great member benefit to you, especially audit costs, which Greg already mentioned. And so it's a really good solution, especially because a lot of employers really, especially on the smaller end, like usually whoever's managing the day-to-day, whether it's the owner or someone else they've hired to do it, is they're wearing a million hats. And so this basically takes all of that responsibility off their plate for administration of the plan. And it's really, really cost effective. And as the assets pool and you get more members to come in, it just gets less, you know, even more cost effective. So it's just going to get better and better. So I'm really excited. And what I love about it too, is there's, like I said earlier, coming into the chamber plan that they're, you know, stepping up to help their members with, we're still going to be sitting down with each employer and, you know, designing their plan underneath that umbrella of what makes sense for them. And so it's not like, okay, you come into the chamber plan, you have to do this plan design. You have to have this eligibility. You have to do an employer contribution. That's not the case at all. We have a million options for each individual employer based on what they're looking for, which I love. Because it's like, we're not having to say, okay, if you come in, there's this great benefit, but this is how you have to have your plan set up. So we're still, even under the chamber plan, not losing that individual plan design for each employer. And that's really where my role comes in, to sit down with each employer, you know, with your financial advisor and help you figure out what makes sense for you.
Well, and you're right. And you mentioned it in your presentation, you know, the majority of these folks that are now going to be mandated to do this 5 or more, you know, between 5 and 50 employees, so to speak. Mm-hmm. It's the mom and pops. They don't have somebody on staff that understands all this 401k stuff.
Right.
They have cooks and servers and salespeople and, you know, whatever, you know, they can't afford to hire somebody. So, you know, having a plan like this that takes away that administrative stuff, or the majority mm-hmm. of it, is going to be key for them, because, you know, they aren't going to understand it. They don't have a master's degree in retirement plans. I mean, there's a lot to understand, and a lot that you need to understand to keep you out of the getting a fine or being in compliance. So
right.
We thought, you know, and that's why the Clovis Chamber is putting their name behind this as a member benefit. Is, you know, this is just a fantastic way for our members to be compliant. You do need to be a Clovis Chamber member to take advantage of this benefit. So, which is, you know, that's the way we wanted to do it, because we want this to be very exclusive to our members. If you're listening out there and you have a friend who owns a business and they need to be compliant, please reach out to us, the Clovis Chamber. We'd be happy to share with them the information on the SMEP. If you're a member already, if you have 5 or more employees, you need to do something. We think that this is a cost-effective way. It's going to take some of the burden away from you on administrative level, and some of the fiduciary responsibility away from you, and keep you compliant. So we're very happy. We want this thing to go forward. We want our members to be compliant. We don't want anybody to get fined.
Right. One of the things I just want to be clear about is if you don't have a plan in place, you can come in and it would be a new plan. You'll be exempt. But if you have an existing plan and you're a member or want to become a member, what we can do is we could do like a free, we call it like a benchmarking, which basically means shopping your plan, making sure your fees are in line, showing you the cost difference of what you currently have in place and what it would cost to come into the chamber plan. And then, kind of go into more details about the benefits of the administrative aspect that we're going to be taking away as well. So just if you haven't benchmarked your plan, or your financial advisor has not come to you in the last few years and said, okay, this is what you're paying, this is the marketplace of a plan your size and how many employees you have, kind of done a comparison. It's definitely something you want to have done, because the Department of Labor, they want you to do that at minimum every 3 years. So that's something that we would do. It's complimentary, so there's no cost for it. We do need a little bit of information. We try to keep it as easy as possible. And so we can do a comparison for you if you have an existing plan in place.
Fantastic. Jessica, I don't know if I have any more questions. Do we have any questions from our group today for Jessica? No, I don't see any. If you have a question about our MEP plan, or what the requirements are, you can reach out to the Clovis Chamber directly. Our phone number is 559-299-7363. You can email me directly at greg@clovischamber.com, or you can reach Jessica directly at, do you want to give us your contact information real quick, Jessica?
Sure. So my cell, which is my only number, I've had since I was 16, is 559-779-8351. And my email is jj@hickspensionservices.com. So HICKS pensionservices.com.
Fantastic. And then also we do have so there's we'll call it the three-legged stool. So there's 3 parts to a pension plan. Okay, so we have and Jessica, why don't you tell us what those 3 parts are, and why don't you tell the kind of the 3 folks that the Clovis Chamber has decided to go with to administer this plan?
Yeah, so you have my company who does all the fund compliance work, which is very, very important and necessary to keep you out of trouble with the IRS and Department of Labor. And then you have the record keeper, which is where the actual investments are held. So in this case, it's gonna be Transamerica. So that's where you're doing your payroll submission. When you do a deduction out of your employee's paycheck, it goes to Transamerica, and underneath the chamber basically umbrella, but they're not actually housing all of the assets with the record keeper. That's where the employee, that's really their interface. So that an app, website where they can log in, make their investments, which, by the way, in the Central Valley, Transamerica is one of the top, with Spanish capabilities in the marketplace. So it's really fitting. That may not apply to your business, but it's really, really attractive. They have a Spanish call center, website, mobile app, and then you have a financial advisor, because as an employer, you definitely don't want to be giving advice to your employees on how to invest their money. So essentially, you're kind of hiring out all of these services that you're required to really be responsible for. So you have a financial advisor that does all the education, investment advice for your employees, and then just day-to-day questions that they have. So the 3 of us work together. And essentially, the reason why it works, it might seem like a lot of parties involved, but really what happens is we all hold each other accountable. So if something is not going well, then the advisor is calling my company, which, by the way, rarely happens, but we're all human. And so we all hold each other accountable, and we all work together as a team. But in the chamber product benefit they're offering, you're really kind of not disengaged, but you hire us essentially, and then we're going to be doing all the work for you on a day-to-day basis besides you running payroll.
And to clarify, the financial advisor that we've been working with is Principal Financial Group.
Principal, yes.
So if you're interested in talking, to Principal, we can start this in 2 different ways. We can start it your inquiry with Hicks directly, or with the financial advisor. They're both very capable of talking about the plan. So if you're interested, principal is their phone number is 559-261-2000. And then Michelle Ramirez is the one that is scheduling the appointment. So if you are ready to make a change from your current plan, or if you're ready to be compliant and try to avoid some fines, I suggest everybody make those calls sooner than later, because there's going to be a mad rush, I have a feeling, with these small employers to be compliant before that June 30th deadline.
Yeah, and it's, I mean, the financial advisor, like principal, they have a local office, so they'll come out to you, physically come out and do education. Having a financial advisor, like a really good team behind you, is really important, especially having someone that, like principal, you can go into their office, they'll come out to you, is a really important aspect. Because my company, we're going to be doing the day-to-day, but we're really kind of on the back end from an employer perspective, having that kind of interface with your employees. And a lot of my clients, just sitting down with employers, with a financial advisor, they really want their employees to be able to retire. Yeah. And so, they care about their employees. There's been a really big shift that I've seen since I've been in this role since 2012. And so having that, an advisor that actually, principal, they want to sit down and meet with your individual employees, your individual planning. A lot of advisors are not interested in doing that. And that's okay. It's just making sure that you have an advisor that understands the retirement plan space specifically and wants to work with your employees on a day-to-day basis and be available for them.
Well, Jessica, you're just a wealth of information. I tell you, I always am just marvel at all the information you have on the CalSavers and what employers need to do. So we appreciate your expertise and sharing that with us today. And hopefully our listeners and our viewers will take our advice and make that call so they're compliant. And because we know the CalSavers, or the state, excuse me, is out there policing. Who is the policing force for fines, by the way, from the state?
It's the EDD, unless it's changed. But there, as far as I didn't get to see the fine notice that this particular advisor, like the prospect, the grocery store chain received. But EDD is in charge of enforcement, which kind of makes sense because they can see all of the employees you're uploading, on a day-to-day basis that you're hiring.
Yeah. And
the average and all the history and all of that.
Well, we know they're out there. We know the state likes to take our money without us, with fines, and they don't seem to care about it. So we want to help our employers and keep them compliant. And Jessica, thank you again. And thank everybody for watching our Wake Up Clovis program this morning.